everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing Matthew Pipenberg, who is a partner at VON GREYERZ, who is one of the leading precious metals advisory services. And so, Matthew, how you doing today?
I'm doing great, Daryl. It's great to be back. Thanks for having me.
Yes, indeed. So you mentioned that you're on the move a lot these days. Gold price is moving.
Yeah.
People are feeling like they are on top of the world, and some people may be scared out of their pants and wanting to get out of the dollar and stuff. And so, what are you seeing on the ground?
Well, obviously, it's even folks who haven't been looking at markets in general or precious metals in particular can't ignore the headlines this year. Headlines that we've anticipated just from the history and math of unsound money and grotesque debt, but. There's just no ignoring what's happening now. Some people think this is too much, too fast, too high a gold price. Where's the correction? Am I buying at a top? I've been hearing that since gold's at 1,600. It's a serious question. I mean, I'm not trying to be flippant about it. And it's certainly when it's at these levels, people think there's got to be a pullback, and we can talk about that, of course. Look, I mean, I've had conversations with Brent Johnson, brilliant man on the dollar. It's a very strong theory, the milkshake theory, and Heinrich Zieberg, who I was at a conference with, a long conference in South Africa. We had a lot of conversations about the dollar. He has a view very much like Brent Johnson that when we do go into a market mean reversion, there's a number of arguments to be made that the dollar is going to spike up again, the DXY will spike, and that gold could have a serious retracement like it did in 2008, like a 30% retracement. These are sound arguments. You can't ignore them. You can't be an honest fiduciary in the gold space and just say gold only goes up and to the right. So these are things we can talk about, but again, my argument is it's a very different backdrop, 2025 than 2008, for example. The dollar's situation is very different today than prior cycles because of things like de-dollarization, which are no longer just headlines, but strong geopolitical realities as part of a debt cycle. So the question about the dollar is still very valid, and it's worth discussing. But to your question on gold, look, what we're seeing right now is really no surprise to those of us who've really been in the gold space for many, many years. And for a long time, people would say, well, it couldn't be a gold bull market because silver isn't ripping or because the miners haven't been ripping. And so we're looking for that kind of confirmation. And ironically, if you just look at just the last week, certainly the last month or this year, silver and the miners are kind of confirming that we are really now entering a secular bull market for gold, not just a one-off for this year. And I was looking at the weekly moves just last week. Silver was up 8% versus 2% for gold. Both are very big numbers, but you're seeing silver really starting to do what it does, that little speedboat next to that juggernaut. Gold being the juggernaut, but that silver price now really starting to take off past the juggernaut. Year to date, silver's up 60% and gold is up about 43%. What is it? It's October 2nd. Those numbers could be off a point or two. The gold price moves in so quickly, but there's no denying that these are huge moves in 1 year. And in terms of the miners, I remember telling my daughter a couple of years ago at Goldman, buy some GDX, buy some GDXJ, and she did. And it's we were looking at her statements.
She's happy.
She's very happy. I mean, GDX is up 120%, GDXJ up 125. So that's almost triple the price of gold. So you're seeing the miners and silver really racing now to catch up with this gold bull market. And people even platinum, which I was talking about earlier in the year as well. I mean, just last week it was up more than the entire S&P for the year. It made 12% move in a week, and I think it's over 70% for the year. So these precious metals, these real money metals, these monetary metals are clearly making a move. And again, we can get into the conversation about the dollar and other things, but they're just simple points. There's simple math. There's simple history at work here. Again, I've been saying for years, and again, this isn't a big secret, but the official measure of inflation, the BLS uses the CPI scale, is an open fiction. And if you just step back from the gold bug versus gold reality, debate, or the dollar debate, or geopolitical debates, or cultural or partisan debates. You just have to look at history. I mean, there was a famous economist named Charles Goodhart came out in the 70s. He basically said all targets are lies, whether it's target inflation, target GDP, target unemployment. Whenever these targets are in, the politicization of these targets gets abused, and they're basically manipulated lies. And that's a strong statement, but I do believe, like John Williams, that the scale used to measure inflation is complete fiction, and I think Wall Street knows that too. But it doesn't have to be right. It's official. If it's official, that's the official number. But if we start from the conservative premise that inflation's at 10%, and again, this is a compounding number. It annualizes. That means your purchasing power, the invisible tax of inflation, is compounding at 10% a year. You're losing just in a checking or savings account. But if you start with this notion that we're at 10% inflation, or if you be generous, 8% or 9%, what that is saying, Daryl, is that every bond from the Treasury, the 1 month Treasury, to the 2-year note, to the 30-year Treasury bond, is effectively not beating inflation, has a negative return, which is exactly what the government wants. They want negative rates to inflate the rate of debt. But that means any one of us listening, whether they're gold or silver, precious metals oriented or not, anyone who holds a bond portfolio, some as much as 40%, in U.S. Treasuries or U.S. safe havens, those return-free risks, well, they're actually losing significant amounts of money every year. It's a negative return. That's a major statement mathematically, and I think for the first time since 1996, central banks hold more gold now than they hold U.S. Treasuries. And again, this isn't just a gold bug case. This is just empirical evidence that the world and the central banks, love them or hate them, they do see what's happening because they created what's happening, and they're holding gold more than this quote-unquote risk-free return, because when measured against honest inflation, none of these bonds are beating inflation. They're losing money. They're constructively in default, because when you get a negative returning bond, that's a defaulting bond. Everyone's losing money, and more people are catching on now to the conversation about gold. Is it really a better store of value? Does it hold its value, etc.? And I would say empirically, there's all kinds of examples where we can show that without looking like we're selling our book. So yeah, Daryl, it's an interesting time to be in precious metals. It's not an I told you so moment. A lot of people have known this. Central banks are catching on. I think what's interesting too, Daryl, is we're all from Wall Street, and my partner was 27 years at Morgan Stanley at the highest level. And Mike Wilson of his bank just came out. Instead of doing the 60-40 bond portfolio, Morgan Stanley is saying there should be 60-20-20, 20% in gold instead of 40% in bonds. Even Morgan Stanley, Wall Street, the whales are now moving towards gold. I think they're probably 10 years late, but they're still coming to the party, and that too is a very, very telling sign.
Yeah, I was reading that article. I think Reuters had put it out, and about the 60-20-20 portfolio with the chief investment officer at Morgan Stanley. Yeah. And so I was wondering, is this a trend that you foresee, or is this trend already occurring where these big investment funds and fund managers are moving towards allocation in gold?
Yeah, it's a very fair question. And again, at VON GREYERZ in Zurich, where I am, I'm not always spending time doing interviews and articles. I've spent a lot of time with clients, and we obviously have privacy is extremely important to us. But I've noticed in the last few years that many of our private clients are current bankers, and many of them are current bankers in the U.S. They are constrained, or they were constrained, as I was as a banker, as anyone who's worked at a bank, as my daughter was at Goldman Sachs or any major bank. There's a reason not to discuss gold. It's deliberately misunderstood. It's deliberately has been ignored. For the last 25 years, the Wall Street sell side has effectively said that gold was too volatile. It's like a pawn shop asset. And for a while, that just stuck. Anyone was in gold was a kook. But ironically, these bankers and these hedge fund managers who didn't talk about gold publicly for many, many years have been saving in gold with us. So that's just an anecdote from what I'm seeing, but it is telling, I think, to your question. Well, first of all, they have to just admit that they were wrong. The S&P, as great as it's been since 2000 in terms of an incredible bubble, has not outperformed gold in the last 25 years. Now, again, you can pick your statistical windows, but 25 years is a fairly good statistical window.
Mm-hmm.
And there's no longer, they can't deny it, not because they've suddenly seen the light. Interestingly enough, a lot of their clients who listen to folks like you and others have been coming to the banks and saying, why have we been ignoring gold all this time? I mean, how could we have not been allocating to gold? It's not just a one-trick pony for a year, a quarter, or a cycle. This is decades. And so now the client demand is pushing banks to meet that demand, and they should, and they're doing it. It's never too late, because I think gold is still in the first innings. But to your question, they're catching on because they have no choice to catch on, because from the bottom up, even the high net worths who've been in 60-40 portfolios or private equity or, God forbid, private credit pools, which I've written about many times, are just the worst places to be. But that's how banks survive. They have to sell these products. They call them Roman numeral 1 through 50. Private equity, 20. Private credit pool 16. In other words, they're selling products for fees. It's a good business for bankers. It's okay in certain bull markets for investors. But to have ignored gold this long, it's kind of egg on the face. And for Morgan Stanley to come out now and say this, as you say, it's interesting, but it is a little bit late. But to your question, for many years, I've seen bankers and fund managers come into my office with a great deal of money they want to hold in gold. And frankly, just last week in Zurich, a couple meetings with Bitcoin millionaires who are converting Bitcoin to gold now. And again, that's another conversation, but those are the things I see. And it is no surprise to Egon, myself, my other partners, because we've been very, very consistent in the history and math of dying, decaying, rotting currencies and systems. Not the total end of the dollar, not the total end of America, but a radical turning point, a fourth turning, a great taking. All these terms have been coming up in the last few years. Mm-hmm. But Egon's been writing about this for 20-something years. I've been writing about it for 10 years. It's not hard to see if you understand history and the cycles of these crises. And gold is just doing what it always does for thousands of years, preserving wealth better than paper money.
Yeah, that's yeah. Thank you for sharing that. So just looking at your article, the 5 arcs and the 7 cracks that lead to systemic collapse.
Yep.
I was actually recently reading the book End Times by Peter Turchin, and in that book, he explains a lot about the wars between the elites, about policies and things of that nature that ultimately impact like the average person, and the average person haven't had wages, keep up with inflation
Right.
since the 70s, right?
Yeah.
And so just it looks like in real time, what we're seeing is a cracks within the system, and the system is collapsing, or it's trending towards that direction, which history would say that. Mm-hmm. And so, could you unpack some of this article with us? I mean, because obviously you have the 4 arcs, the 5 arcs, and then you have the seven cracks.
Yeah, of course. I'll briefly because I think it's an important thesis. Again, this isn't partisan. This isn't data picking. It's just looking at cycles of history. And I think it's fairly empirical and fairly objective. And the whole kind of thrust of that article is, let's step back from the arguments, the debates, inflation, deflation cycles, strong DXY, weaker DXY, gold pullbacks versus just ripping straight up into the right. Let's just step back and just understand gold, money, and the system we're in. I wrote a book in 2019 called Rigged to Fail. And a lot of the things I wrote about 6 years ago are literally just playing out now, not because I'm some brilliant genius in the markets, or I understand Keltner bands better than others, or buy and sell signals. Ironically, and as I've found with many of the best mentors, including Egon, or even bankers or hedge fund managers, they were almost all historians before they were economists. In other words, they understood history. And if you take the time to do that, that's what kind of was the impetus for this article you referenced. And the article basically just says there's the elephant in the room, which I've talked about ad nauseum, and no one wants to hear me bring in the data, but we are in a debt crisis. That's the problem. We have a major unsustainable debt crisis. And the data for that, I won't go into because I've done it too many times, is undeniable. And the cause for me is very simple, and this is something Adolf Thiers and Robert Triffin and Charles Goodhart and centuries back, Gresham, Sir Thomas Gresham, 1500s, they all saw these cycles. But when you go off of real money, when you go off an asset-backed money, like Article 1, Section 8 of the Constitution said, gold or silver, and you have fiat paper money, you can increase your debt, and we had this debt crisis. It began in August of 1971 when Nixon decoupled from gold. That took away the chaperone. And I always say, as any of us who were teenagers know, when the parents are away, bring out the house party. Because when there's no chaperone, there's more fun. And when there's no chaperone on money, there's going to be more debt you can spend and deficit spend, and then pay for that with mouse click money. That cycle began in 1971. And the consequences are fairly obvious. There's three major consequences, and the first one is just debasement. The currency gets debased. This has been since ancient Rome to today. There's nothing new here. This has been done in many ways. The Middle Ages, ancient Rome, 18th century England, 19th century parts of Europe, certainly 18th century France. So, dollar debasement after the debt. The debt decoupling. First consequence, dollar debasement. The second consequence, which is a little more vague but really just as obvious, is dishonesty. And if you want to be politically incorrect, just lying. We lied about when we decoupled. We said that the gold would go down. It went up 8,000%. We said the dollar would get stronger. It's lost 99% since gold. We said that the decoupling from gold would be temporary. That's been 54 years. So those are just the original lies. Then there were other fantasies like modern monetary theory, that you can mouse click money without inflation or expand credit without debasing currencies. Those were other lies. Those were economic lies with fancy names that were misnomers or oxymorons. We've also seen more recent lies that we're not really in a recession, and I can argue empirically that we're in a recession. We have been for a while. When we hit that in 2022, they just redefined recession. Or that inflation would be transitory. That was a famous lie. And the other lie that...
Really famous.
Yeah, when we just talked about that gold was too volatile. Those are all lies. And the third consequence is desperation. When you're a government or a nation that's over its skis in debt, you start looking for policies that will save you. Tariffs are going to save us. Stable coin is going to save us. Cutting spending at USAID and Doge. These are all, that's going to save us. AI is going to save us, or maybe even a gold revaluation will save us. And again, each of these silos we could spend an hour on. But those are the symptoms of the desperation. And then the symptoms that the jig is up, and I'll finish here, Daryl, is really that there's so many symptoms that we're seeing and debating and arguing about for years that are coming to fruition now, that the world is catching on to these desperations, these lies, and these cycles of debt. And de-dollarization is one of the most obvious themes. The DXY, when I had that debate with Brent Johnson a few years ago, the DXY was, I think, 110. Now it's at 97. Again, doesn't mean it can't go up again. We could talk about that. But that's a clear sign. The QE, the money printing, and the inflation in the stock market is a clear sign that there's something deformed in this rigged system. The bond market, no one is buying U.S. Treasuries at nearly the same pace because they don't trust an over-indebted, weaponized IOU from Uncle Sam. The panic we've seen in the COMEX, gold flowing in and out, taking delivery rather than sitting there for leverage. The central bank stacking of gold, which has tripled since we weaponized the dollar in 2022. The obvious replacement of gold for the U.S. Treasury as a Tier 1 asset, and even the less use of the petrodollar in the oil trade. And finally, even Judy Shelton talking about a gold-backed treasury. I think she's very serious about that. I think that's very possible. That's an admission that the dollar isn't trusted, the U.S. 10-year isn't trusted, a 30-year. What we need is a gold-backed treasury. So all of these signs, Daryl, to answer your question, that was in that article. That was the thesis I was trying to make objectively, that this system is absolutely radically shifting, and the next 10 years are going to be radically different than the last 10 years. And that doesn't mean the end of America or the end of the world, but it means a very different, more austere, more splintered, more polarized America internally, as you and I both know, is very real, and a more polarized reputation of America internationally in terms of relationships with other countries, other blocs, including even Europe. You can say that's the Trump effect, but it's more than that. It's the debt effect. So, international relationships, geopolitical tensions, credibility in the dollar, the U.S. Treasury, these are all symptoms that are all tied to that original patient zero cancer, which is debt to these levels with the world reserve currency. I think they're fairly undeniable.
Yeah, definitely. A lot of great points there. And that article was just so clear, so simple. Like the average person could just go and read that and understand what's happening. Obviously, there's multiple layers and data and information underneath each of those arcs and cracks, but I appreciated that.
We've got three of the best porphyry copper targets that I've seen in the past 25 years of exploring for porphyries. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. We've put our foot on two outstanding projects in central British Columbia with copper and gold and some molybdenum in there. Our Poplar South project, we're drilling there at the moment, and I think we're on the verge of a major discovery. If you want to learn more, you can find us at vizslacopper.com.
I do want to talk about one of the cracks, which is the S&P. Obviously, the S&P's at all-time highs measured in dollars. In your talks with Brenton Johnson and the perspective of like, okay, well, at some point, people are going to need liquidity. They're going to run out of dollars, and then the dollar's going to shoot up or whatnot. In reference to that 2008 period, I mean, then the question becomes, well, how high gold will be when we have that situation happen? I mean, because gold could be at $10,000 and maybe correct down to $8,000. Right. So it's kind of so for me. I wouldn't want to play that game. I think that game is risky, and I would want to park some money in gold. And then I also want to talk to you about the S&P, because many people would think that, okay, well, the money helicopters are going to come. They're going to save the day. They're going to inflate the bubble again. They're going to continuously do that. But at the same time, as they inflate the bubble, they're debasing the currency. And so I'm kind of wondering, is the S&P even going to keep up with inflation, and such, especially as they continue to do that? And so I want to get your perspective there.
Yeah, those are key questions on everyone's mind, especially those kind of newer to gold, and the fear that, man, we missed out on this, or God, there's nothing worse than buying at a top. And again, and then of course, what's going to happen with the market? And will market inflation at least capture some of my fight against inflation? So should I stay in this S&P? And can the Fed save it, airbag it, print more money, save the market at the expense of the currency, but at least beat inflation? So these are valid, important questions. I think, as I was kind of hinting earlier, even when gold was at 1,800 or 1,900, people thought, this is too high. And of course, now looking back, they were glad they came in then, or regret that they didn't. At 3,500 or 3,600, is gold too high? I think the first question is, first you got to ask, and this is not for me to answer, this is up to each listener, why are you investing in gold? If you're investing to speculate or get a return, a percentage return on your cost basis, and say I made X return, again, this year, certainly gold and silver have outperformed even some of the most sexy tech stocks. So in terms of a pure speculation play, yeah, that's did I miss my run for this year to capture some of that alpha or that beta in this market, however you want to look at it? That's a very different question than why am I buying gold for the 20-year period, the 10-year period, not this last quarter or this year. If you're buying gold because, like me and our clients and Egon and many others, if you're buying gold because you don't trust that beautiful ice cube that is the dollar bill or the euro or the yen or the peso, whatever your currency is, or the Swiss franc, if you don't trust that melting ice cube, which again is objectively melting, you should be buying gold with at least a 10, 20-year vision. This is not just a one-off investment opportunity to get a quick return. And so that would have to be the first question. If you're a speculator or you're a long-term holder of gold, if you're speculating for return, we can talk about the risk there. If you're holding for the long term, there's almost no risk, because we objectively can say that currencies are going to be debased. They have been debased, and there is no other way but to debase currencies going forward. So yes, when gold's at 10,000, 15,000, 20,000, you're going to preserve your wealth better, because a loaf of bread, a trip to the hospital, tuition for your children is going to be significantly higher too. It's not that gold's just suddenly going to make you wealthy, but it's going to prevent you from getting that invisible tax of currency debasement and inflation. So that's a no-brainer. Whether you buy at 3,800 or 1,800, or like my colleague Egon at 300, you're going to be glad you own some gold. So for the long-term investors, there's no doubt that I can say, and I'm not selling my book, if you can afford an ounce here and there, a gram here and there, and start stacking this insurance for openly dying fiat money, melting ice cubes, you really don't need to look at the price if you're thinking 10, 15 years out. I don't want to tell you, I promise you that the price will be higher next month, but I'm fairly confident. I can't promise you the world isn't flat. I'm fairly confident it is round, but I will never promise anything. My view is that gold will be significantly higher than it is today 10, 15 years out, which is why I have my children investing in it now in their 20s, because it's a great investment longer term. If you're looking for that, well, if I buy it now and it pulls back, if I buy it 38 and it pulls back, even if it did, and it could, it probably wouldn't pull back more than 3,000. But again, you can't know that for sure. But if you're an investor looking only for speculation, a quick return, you could argue, as Heinrich Sieberg has said, who, by the way, is ultimately bullish long-term gold, and Brent Johnson, who has a different view of the dollar than I. All of us share the same view across, in even the Bitcoin crowd. We all share the same view. We have different views on Bitcoin or different views on the DXY and the dollar near term. We all agree in the long term, the dollar loses and gold rips. It's just a question of what your window is. So I think that's something that if you're really just looking to buy low and sell high and you think there's a pullback, that's a decision you have to make. If, like all of my clients who never ask about the gold price, and they're from 90 countries, they don't care. Egon and I never look at the gold price literally unless we have to do an interview, because we just know over the long term it's going to keep going high because of the historical things you and I spoke about. So that's kind of the first question. It really depends on what your goal is. If your goal and you're cynical about government misuse, drunk driving, mismanagement of the dollar and the debt system, I can assure you that whether we have CBDC or a great reset or whether we inflate our way out, no matter what happens in this next disastrous turning point, gold will go higher, and it will hold your purchasing power and preserve your wealth better than any fiat money in the world, from the yuan to the peso, the dollar, the Swiss franc, to the Canadian, Australian dollar. That I'm absolutely confident in saying. In terms of, will the market be another place to go to try and beat inflation? If inflation really is 10%, can you at least get 12%, etc. on the market? Will that bubble, will the Fed always save the market to help you at least try to get some return, so you're not just on this hamster wheel, just running in circles and getting nowhere? I mean, look, the S&P, if it's at 12% and real inflation, honest inflation is 10%, you're beating inflation by 2% on what they see as a good market this year. I think there's a lot of risk in that, and I've been a risk asset trader for long before I was a gold investor. Getting annualized return of 12% or better isn't always easy. You would say the moral hazard now with the Fed basically there to put an airbag under this market, which is just ridiculously overvalued by every metric, price to book, price to sales, the Buffett ratio, compared to foreign equities, it's 7x the global index. So yeah, this is a clear bubble. Will it always be this way? My view as someone who's a veteran of risk assets, long short equity, stocks and bonds and credits, is nothing in the risk asset space is always up and to the right. They're few and far between, but the laws of mean reversion still exist despite this incredibly Pavlovian, Fed-supported, totally deformed stock market. It is a centralized market. It is killing price discovery. It is killing value investing. It is a pure momentum trade stimulated by Fed stimulus. Despite that, I still think there's plenty of indications that at these all-time highs, market mean reversion is more of a risk today than it is at any other time. Does that mean I can time it? No. Does that mean I can promise you a 40, 50, 60% mean reversion? I can't promise it, but I'm not the only one in the room who thinks that's coming. We can look at the signals, and the main signal to me we can talk about, the main signal will be interest rates and net income margins on the stocks. But I see mean reversion, just like Jeremy Grantham, just like Druckenmüller, just like Paul Tudor Jones, just like Gundlach in the bond market. So these aren't gold bugs that are warning about the risks in these markets. It's a long way, Daryl, of me saying if you think the stock market is a safer place to beat inflation, I think it's a far more volatile place. I would not want to be hedging against inflation at the top of an asset bubble like the stock market. I'd much rather hedge at the beginning of a secular bull market in precious metals. It's a far better safer, historically confirmed way to protect you from currency debasement, from the invisible tax of inflation, from unsound money. It's a far better place to not only preserve your wealth, which is the main role of gold, it's also a far better way to have the optionality of price appreciation, because gold will go up because fiat money will go down.
Yeah, definitely. So I do want you to chime in a little bit on interest rates. So obviously we've been in a secular decline of interest rates for about 40 years or so.
Yep.
And we had interest rates come up, and then now there's a lot of pressure to bring them back down so that more cheap money can be spent and whatnot. And so one of the other cracks that you mentioned is U.S. Treasuries as well. And so what's your take on interest rates? I mean, if interest rates were to rise, do you think more demand could come for Treasuries? And then also, what is that? What are those auctions looking like? Like, I don't necessarily look at them like all the time. And so is it like just abysmal where where no one is there like raising their hand to buy some of these treasuries, or what?
I mean, the most recent example of that really was in April, right, with Liberation Day. The tariff announcement, these were big classic Trump start with the big, let's do 100% tariffs on China or 50% tariffs on Switzerland. Well, what happened in April when the markets lost 10 trillion in like seconds is that Trump had to change his way. It wasn't because he thought, or the markets thought, that tariffs were going to destroy the stock market. The reason the stock markets puked in April was the day after Liberation Day, there was a treasury auction that wasn't empty, but there were a lot of crickets there. In other words, no one was showing up. And that's when I think, and again, this is just my opinion, that's when I think the jig was up on Liberation Day. In other words, the bond market was telling Trump, you can't execute or prosecute tariffs to that level. You can get the political optics, the strong arm, the chest puffing optics of it, but the bond market won't let you, because the world reacted by saying, well, unbelievably, we're not going to react to a tariff from the U.S. on the rest of us by buying the U.S.'s IOUs. Not a big shocker. If you expect the world to buy your debt and to buy your IOUs, again, this is not partisan, but you may want to make friends rather than enemies. That's one argument out of the rest of the world, because no one showed up. So immediately Trump did the two-step on the tariff, the extent of the tariffs, and the scale of those tariffs. And then the auctions were coming in. The bond market and the rates, again, seemingly very, very boring things to the average investor or person trying to make sense of this world. I get it. Rates, bonds, yields, 10 years, 2 years. It's meant to be a little wonky and complex so you don't understand it, but it isn't beyond the IQ level of anyone who's curious about the world. Anyone can learn this. The irony is, as I've said so many times, the bond market is the thing. It really is. And it needs to be understood at a simple level. As bond prices go down, yields go up. Okay, it's that simple. Bond prices go down when there's less demand for those bonds. And when yields go up, especially in the 10-year, that yield in the 10-year is absolutely important, because that really is the true cost of debt. And the true cost of debt, if debt is what's making this, the debt is the rotten wind beneath the wings of a debt-based growth, which isn't really growth. But debt is critical, and the cost of debt is critical. So if there's a failure to bond auction, or there's less demand for Uncle Sam's IOUs, whether it's because of Trump, whether it's because we weaponized it, whether because we're just in too much debt, whatever the different reasons are, that you can pick your reasons, and they're all kind of coming together, less demand for those bonds means yields go up. If yields go up, the cost of debt becomes unpayable or difficult. And so what Trump learned in April is you can't prosecute a trade war or a tariff war because the bond market won't let you. What Powell learned from March of 2022 to June of 2023, you can't raise rates to fight inflation, because that means the cost of your own IOUs, the cost of your own bar tab becomes so expensive that you have to print more money to pay for your own interest expense. So your war against inflation is literally an inflationary policy. You're trapped. And that's why the bond market really matters, and rates really matter, and the yield in the 10-year really matters, because it's not an academic thing. We've just seen two case studies, as you'd say in business school, two case studies where the bond market has more power than the Federal Reserve or the White House. And again, that's not partisan. That's just the laws of math and the laws of debt. And with this latest rate cut by Powell, look, you got to look at what Powell's doing, not what he's saying. The Fed has caved to politics. He had to cut rates, you could say, because there was so much pressure. I mean, the president's calling you a loser. I'm not sure that inspired Powell, but we need lower rates because of the level of debt we have. And he's also confessing between the words of his press conference is that whether our key mandates are inflation or full employment, right now, inflation, we've given up on the war against inflation. We've just shown that we couldn't beat it. It's not transitory. We lie about how much it is. He didn't say that, but he's basically giving up the war on fighting against the war on inflation. And he's now more worried about full employment because we had that huge $925,000 downward, 25,000 person downward revision from the BLS. So labor was a problem. When labor is the data they look at, it's time to cut rates. And of course, that's the reason they give. It's not really about labor. It's about our own bar tab being too expensive. And of course, maybe not of course, but when you cut rates, typically that means a weaker dollar. And that's really a policy that Trump feels that a weaker dollar will help us with trade because we have a trade deficit because the dollar is too strong. All American widgets, toasters, etc., tech products cost more overseas because our dollar is too strong. So to be competitive with trade, we need a weaker dollar. We need to bring rates down. That's completely wrong. And this is Robert Triffin's dilemma. When you're the world reserve currency, your dollar is going to be in greater demand. You're always going to run a trade deficit. You're going to export manufacturing. That's just the law of math. So Trump and Besant were just dead wrong on that. But that was another argument. We need a weaker dollar to help our trade deficit. And so, again, complex things. We write about these things a lot, but lower rates are just a capitulation that we've lost the war on inflation. And what that means for the people listening here is when you lose the war on inflation as a policy matter, that's great for debates in Congress and the Senate and the White House and politicals are trying to get elected. That's a topic. But as you all feel at home, when you lose the war on inflation, the real victim isn't going to be anyone in the Senate or the White House or the Fed or in the top 10% of American wealth. The real victim is going to be Main Street because inflation is that invisible tax. It is a wealth transfer. And what Powell just did is show us that, we're throwing up the white flag. Inflation's coming. And I think what's really interesting about this goes back to history, Daryl, because there was an 18th century Irish-French economist named Richard Cantillon. And without getting into all the weeds, this is, again, just another example of math and history teaching us these things. And again, 18th century, not 2025 Trump America, Biden America. This is not partisan. This is math. He said that, inflation's a wealth transfer. It's a rigged, intentional wealth transfer. I wrote about this in Rigged to Fail. Inflation is a policy. It's not a mistake. And when you look at the history of inflation, whether it's Weimar, whether it's 18th century France, whether it's 2025 America, whether it's the EU right now, inflation always benefits the early movers first. When we started QE under Bernanke way back after the 2008 crisis, QE was supposed to be QE. Then it became QE 1, 2, 3, 4, Operation Twist, Unlimited. That was inflationary policy, but the vast majority of that inflation went right into the S&P. There's no denying that the S&P and QE were hand-in-hand correlated. More money you printed, the higher the markets went. That benefited, that early inflation went to the risk assets. 90% of the U.S. population doesn't have a lot of money in the stock market compared to the top 10%. In other words, the top 10% own 90% of the stock market wealth. So they were the beneficiaries. If you owned a home in 2009 and you had a stock portfolio, even though you'd just been hit by the great financial crisis, if you were in the top 10% of the American social hierarchy, Powell and the White House and the policies post-TARP, post-2008, just made the rich objectively richer. What it does, and this is what Richard Cantillon said in the 1700s, is that's nothing new. And what happens next is the middle class, the man on the street, Main Street versus Wall Street. I've written about this so many times. They get the long end of the stick, the wrong end of the stick. Their inflation isn't in risk assets. It isn't in stocks and bonds. It isn't in real estate because they never had any to begin with. It's just in the higher cost of goods, the higher cost of services, the higher cost of a Ford 150, and they can't get that. Kids 28, 29 come out of school, grad school, undergrad, they can't buy a house within 5 years. They can't afford the down payment because the prices are going higher than their wages, and the inflation, which is invisibly killing them, isn't reported honestly. This is, again, something Richard Cantillon said centuries ago, and it's happening over and over. What we're seeing right now is nothing new. It's just another cycle. And as Charles Goodhart said in the 70s, we'll just lie about inflation and make a lot of Americans feel like they're not successful. Why can't I get a house? Why can't I afford a pickup truck? It's not because they're failing to work hard or try hard. It's because their government just ruined that ice cube, that dollar they measure their wealth with, which they need to buy something with. The beneficiaries of that inflation policy, which really began in 2009, was the banking class. It was my class. It was the Wall Street class. Those of us who already had money in the markets or real estate under our belt, those markets ripped up into the right. While most people who were just the backbone of America didn't participate in that. And I'm saying this is nothing new. This is throughout history. It is a rigged system. If you're not in that system, you're not going to win it, typically. It wasn't designed for you. And that's why Egon and myself, even though most of our clients have to be high net worth, all of them, because our minimums are so high, we talk 90% of the time to people who can't be our clients because I'm from the lower middle class in the Midwest. I want more people to understand gold. I don't really need them to be my clients at this point. I certainly want them to understand sound money and how they're being absolutely gut punched by their own system, left and right, by the way. This isn't an anti-Trump thing. This is an American cyclical, the darker side of not capitalism, but capitalism has been taken over by central banking and by a cabal, really two gangs, left and right, where a central bank picks its winners and losers. And if you don't think you're on the winning side, it's probably because you're not, and you weren't intended to be.
Yeah, yeah. And there's, just learning about the elite class, that war over policy and such, and how that impacts the average person. Yeah. A part of what you wrote as a crack was the leading to civil unrest and populism, continuous wars over internal wars over gender identities or social identities and such. And ultimately, it's a rigged game that's pinning people against each other. People are upset they can't afford a house. They can't, they're having to work two jobs, working gig economy jobs and such, and do multiple side hustles to even survive, right? And so, how does that look moving forward? I mean, historically, that turns into some internal conflict. I mean, historically, it has turned to civil wars and such. And, because people are looking at who to blame. Many people are blaming the same person that's in the same position as them, right? And they don't know where to turn their attention to. And so I think it's a serious issue, that we're facing.
Sure. Look, and again, this is absolutely, we're all participants in this, whether we're left or right, center. Look, any of us listening knows that if we just got a $100,000 bonus, we're feeling good. And if we just got a big paycheck, we're feeling good. If we just got a new job and we're feeling good, we're nicer to our spouse, we're happier with the kids, we're more fun on the softball team. Whereas if we just got laid off, or we just lost a big chunk of our portfolio, or if we just realize that our income isn't making enough, so we're worried constantly about our mortgage or our rent or making the month end, we're not as fun to be around. We all know that. Anyone who's lived, whether you're a college student eating rice every day, or whether you're a Wall Streeter who just got laid off and you have to sell the Ferrari, whatever your situation, when you're out of money or you're worried about getting through the month, you're less fun to be around. That's just simple. But when that's at a larger cultural level, when everyone in the middle class is effectively the working poor, empirically, by so many measures, by credit card delinquencies, by wage versus inflation growth, by the grotesque ratio between management and lower level employees, how management now at historical levels pays themselves significantly higher than the workers. Again, I'm not a Marxist, I am a capitalist, but this isn't capitalism working. What Jeff Bezos pays himself compared to the average employee is simply pathological. I think he's a psychopath. I really do. It doesn't mean I'm anti-capitalist. It doesn't mean I'm not about getting the most you can for the efforts you make and enjoying the life and the freedom that money gives you. But when you have a middle class, 20% of which have to take two jobs because they can't live on just one job alone, when you have a middle class that's seen record high car repossessions, who can't make credit card payments, where the interest rate on that credit card is 22%. That's appalling. When you look at the small business bankruptcies, again, we go into these verticals, they're objectively crushing the middle class, which again are more now the working poor. There is very little middle class left in America. I see that again in my hometown, not with the polo pictures in Zurich and the life I've enjoyed. So I'm very sensitive to it. I'm not bragging about it. It's something that bothers me to the core. So when you get this at a cultural level, you start, well, is it the fault of the immigrants? There's many cases to be made about over immigration policy. I'm not against these arguments. There's questions about transgender. You and I both know that race relations in America have gotten worse, not better, in the last 10 years since we've polarized this debate. So there's always someone else to blame. And there's always another group that you can get angry at. When you're stressed, it's easier to attract those kind of feelings. Does that lead to civil war like 1860 America, North versus South? No, in my opinion, it's not that type of Gettysburg, Manassas, Gaines Mills civil war. It's more of just a divided state where people start to pick their zip codes, pick their crowds. You won't see an actual storming of Fort Sumter. What you'll see instead is red states and blue states. You'll see, well, we just saw with Charlie Kirk, massive polarization where if we don't agree, we're willing to kill if we don't agree. Or you could argue the anger, the patience. And the other thing that you see is across the board, whether it's people talking about the Kennedy assassination, MLK, Charlie Kirk, whether they're talking about COVID policy, whether they're talking about 9/11, whether they're talking about Wall Street, or whether they're talking about the Trump White House or the Biden White House or the Bush White House, you and I both know, and that's the same here in Europe, the trust, and certainly with COVID, all these things, the first reaction now when any major headline comes is, I just don't trust the official story. I don't trust the FBI. I don't trust the CIA. I don't trust the White House. I don't trust my neighbor. I don't trust the immigrant. I don't trust the darker person. Everything is polarized. So I don't think it means pitchforks in the streets, because there's so many people to throw a pitchfork at, you don't even know which one it is. It's more polarization politically and culturally, understandably, but I think it comes down to something as reductive as I'm broke, I'm stressed, I'm angry. And when you get a culture that's broke and stressed and angry, you have to control it. That's why I've always said the end result for social unrest, again, throughout history, without exception, going back centuries to today, debt crisis, inflation crisis, social unrest, extreme control from the political left or the extreme political right. Whether it's the extreme left or the extreme right, we get more centralization. So in addition to currency debasement and lies meant to hide that, and the centralization that we see from stablecoin to CBDC to digital IDs now in the UK that are required. In Europe, we have wealth registries. In the US, we have stablecoin, which is just CBDC. It's a wolf in sheep's clothing, wolf in sheep's clothing. And then the Patriot Act, all these things, again, left or right, we are losing civil liberties. We are losing personal privacy. We are already the victims of financial repression because interest rates are lied about. I mean, the inflation rate, is dishonest. Every one of us, rich and poor, is losing money to inflation every day. That's called financial repression. That is centralization. That's not it's coming doom and gloom gold bug argument. That is a reality right now. It's been that way for years. It's meant to be complex, and the plumbing's meant to be complex. So the average American who can't buy a house and groceries make it harder to go to the movies this week, and man, I really can't buy a new car or even a used car, they don't really understand that that's actually an intentional policy to inflate away debt at your expense. So that is financial repression. That is a policy. That's the Cantillon effect. And it's lied about, and that's Charles Goodhart's point. And so I'm saying what's going to happen is we're going to see more centralization. So this combination of more centralization, more dishonesty, is a direct result of the debt. Again, you can get really complex into social issues. They're very complex. I don't want to reduce everything to money, but it comes down to being angry. And most people are angry. It's like Neil Ferguson. You stand out in the rain long enough, you'll get in anybody's car because you're desperate. Any ideology will work because deep down the real issue is You're being lied to about your currency. You're being lied to about financial repression. And very soon you're going to be lied to about capital controls, how much money you can take in and out of the country, how much you can travel. We're seeing that already. So these aren't gloom and doom things to project. It's actually happening right now. We're all frog boiling in it together, but the middle class, the working poor, as I've said so many times, they're the first to get drafted in every war, and they're the first to get shafted in every economic turning point, and that's nothing new throughout history. It's just nothing new.
Yeah, it seems like the when you look at the Maslow's like hierarchy of needs, in those bottom core fundamental things that people need to even get to the point to where they can be self-actualized or successful or feeling confident about themselves. Like, many of folks aren't meeting those basic needs, and a lot of that goes back to like the money being inflated away, and you're struggling to put shelter over your head or put food in your stomach, or you look at the food lines at some of the food banks, like they're super long too. And so all of those things, they're all intertwined together. And so just thinking about what people can do. So obviously, storing, some of your wealth or preserving your wealth in gold is important. What are some other important things that people who are navigating, these dynamics? Because obviously, history, they say it doesn't repeat, but it rhymes, and we're seeing a lot of that happening now. And so, what are some kind of things that you think are important for people to consider, in addition to like gold and preserving their wealth? Yeah,
very Pollyannish answer I'm going to give, but it's the truth, and it's philosophical, because we'll definitely get to investments in gold and other ideas or risks. But I think the very first thing that Egon and I talk about, other than recognizing that ultimately get past all the anger, get past all the noise, the best things in life really are free. Good relationships, good friendships, help each other out, have a real sense of community, stop being told who to pick and choose, feel that in yourself. Ultimately, we're all going to end up in a cemetery one way or the other. We're not going to take our last breath worrying whether we had a Range Rover or a Ford Pinto. That won't be the thing we remember. So keep things in perspective. That doesn't change the fact that if you're worried about getting into the month, that's not going to help you right now. I get that. The first thing I think that is free also is to get informed. Again, not just listen to Matthew Pipenberg or Brent Johnson or Grant Williams or John Rubino or Grant, whoever you pick. There's lots of really smart, honest brokers out there trying to educate us, and we have to pick who resonates with us, and we have to then pick a few that can teach us about the world we're in economically, not how to live your life, but how to become informed about things like bond yields, currency debasement, the basic history of money, of the cracks and arcs in the system, which is not Hemingway. It was Einstein said, if you can't explain something like that a 10-year-old can understand, you're not doing your job. Wall Street, private wealth management, all that is meant to be complex. When I write articles like this one we talked about, it's meant for whether you have a PhD in applied math or you never went to high school. If you can read, you can inform yourself. And being informed gives you some power in a very rigged system. First is to be informed, not just emotional, angry, finger-pointing, cynical. You first have to see the battlefield before you can pick cavalry, artillery, or infantry. You have to at least understand. Otherwise, you just feel helpless, and to your point, people feel like they failed, it's their fault, they're somehow less than their father's generation, they're not equal to their peers. And so things like inflation and these invisible taxes have very human consequences. So one way to get out of that ignorance and that frustration and that anger is to get informed, and that's free if you take the time. So I would really recommend, and I always say this, get informed, because not everyone can buy an ounce of gold or an ounce of silver. That said, and as I do think, and I will get beyond precious metals, if you're trying to figure out a way to survive in this system other than being informed, more logical, less emotional, you can be angry about what the information tells you. If you can, an ounce of gold right now is very expensive. Silver is still, they say, the poor man's gold. I call it the smart man's silver, because silver is still on a relative basis affordable. Its ratios, its gold to silver ratios are nowhere now where they're going to be soon. I think silver is probably one of the best values in the monetary metals even though it's knocking on the door, if not crossing 50, it changes every 30 seconds if I look at the screen. But I mean, silver, I do believe, is the best value in the metal space right now. I still ultimately hold more gold than silver, but anyone who can skip a few Friday dinners can start stacking a little bit of silver right now. Not to get NVIDIA rich, not to buy a Porsche, but to protect yourself from what your government isn't doing for you, which is your dollars are melting. So that's the first thing. Again, that may seem like too little too late, but if you hear this now and you've done it if you heard this 5 years ago, you'd be in a pretty good position right now. And 5 years from now, you'll be in a pretty good position. Don't think you're too late to start being a metals investor, even if you have a very modest income, even if you're trying to just get through the month. It's not meant to get rich quick. It's not the lottery, but it's something you can do with your head down, quietly. No matter how frustrated you are, you can buy a little bit of silver, even some grams of gold. It doesn't mean the price only goes up and you never have to worry. It's just a small insurance policy against dying fiat money. That's the first thing, that no matter what your economic situation, you can get informed, and you probably can start buying a little bit of silver and some small amounts of gold. If you can afford more, even better. The other thing I would do, if you're in a 401k or you're a teacher or you're a dentist, you have a retirement plan, whatever it is, and your advisors still have you in these totally correlated, high stock bond correlated portfolios, and they're not protecting you in short duration T-bills or in cash, you don't want to be all in, even if this market, as Goldman Sachs says, is heading to 6,800. That's fine, but you don't want to be all in and measure your retirement on a portfolio that is in an objective bubble. You want to have far more dry powder, I think, than most advisors would recommend. And you would want to ask them, honestly, why do you have me in bonds when inflation is killing the yield on those bonds? I'm not even making money. Why could I not be in other assets? I would much rather be in physical gold or silver than GLD or SLV, because there's a lot of reasons I don't like ETF gold or silver as much as real, but I realize for some of you who are listening who don't have those choices, but you can allocate through a 401k or defined benefit program, be more in gold and silver and the miners right now for the next few years than you are in stocks and bonds. And ask tougher questions to your advisors. The other thing is, the U.S. markets are, I'm not saying they're going to blow up tomorrow, but I'm saying they're clearly overvalued. There's better value in European markets. There's better value in emerging markets if you're looking 10 years down the road. For those that are really with their backs against the wall, there is no easy answer, Daryl. The simple answer is, it is not a good time. It's really hard for the middle class. There's no quick fix right now. It's just, you've got to bleed less. If things are going to get more austere, more centralized, don't think the stock market's going to save you. Do not think the Fed is going to save you. Don't think the White House, red, purple, polka dotted, blue. I don't care who's in the White House. Again, I've said many times, I'm past that. Most of us and our clients are past that. No one's going to solve this debt crisis. No one. We are going to have austerity. We are going to have currency debasement. We're going to have more centralization because we have it right now. It's only going to just go degrees higher. So, for those that are really trapped, there is no simple answer, but it's try to bleed less. If your government can't and won't back its currency with a real asset, you have to slowly try to accumulate your own. You have to question your financial advisor, who usually just flogs the same portfolio every year. You have to look at other markets. And you don't want to be all in. Then again, holding in cash in a mattress, you're losing to inflation. So it's an extremely difficult time to try and be making it through this. I wish I had an easier answer. I don't want to give false hope, but you got to be realistic now. Hopefully, more of your listeners are a little bit more prepared.
Yeah, for sure. I think many of our listeners have been in the space for a while, but some of them are new and discovering this space. Yeah, it was when you mentioned that, I was thinking about a couple of stories recently. I met with a really good friend of mine, and we were just kind of talking about the future. We're the same age, and then she was telling me about her retirement portfolio, and so we started, having that discussion. Okay, how much are you putting away? Are you going to be prepared for the future, whatnot? And she showed me that she had invested, I think it was $3,000 into the account, and her job matched her $150.
Wow.
And I was like, dang. I was like,
Yeah.
we got to have some conversations
Yeah.
about like,
Yeah.
like you know, and
Right.
so, you know, like those are
Right.
like some of the real life stories, you know,
Yeah.
and and so I definitely resonate with what you
Yeah.
said and everything. So,
That's
well,
frustrating.
Matthew, appreciate you for coming on the show and everything.
Mm-hmm.
Where can people, you know, obviously you got a book out, you know, you're writing articles and such. Where can people find more about what you're up to?
Yeah, I'm with VON GREYERZ. It's a tough name in the U.S. In English, vongreyers.gold, with simple URL is goldswitzerland.com or vg.gold, and that's where Egon and myself partners. All our articles and interviews can be found there. There's legacy articles that go back many years. So again, the education is free. We have advisors and articles from now Alistair McLeod, who's an extremely brilliant. I mean, Alistair and Egon were doing banking and rate deals when I was still in diapers. I've got the best mentors in the world. And Ronnie Sturfula and Grant Williams. It's a very solid place to get a free education. You don't have to be a client. Click on our insights page. You can see articles going back years. You can educate yourself. And of course, interviews like this will be there. So it's a free education, and there's a lot about not just why gold, but how to own gold. And obviously, for those that have the net worth to invest seriously in gold outside of their own jurisdiction legally, it's the smartest thing to do. Then we have a great service. It's more than just a gold bug hangout. We have the best vault in the world. We have the best service and the best liquidity in the world. So for those clients, we're great. For the rest of you guys, it's a free education. I think it's a fairly objective, fairly easy to understand education. Challenge us, argue with us, debate us, but it's all there.
Yeah, that's good. Well, you all be sure to go check that out. Be sure to hit the subscribe button. Love to have your support for the channel, and also click the link that's pinned in the comments. That is to the Vancouver Resource Investment Conference coming up in January of 2026. So love to see you there. Thank you, Matthew, for coming on the show.
My pleasure, Daryl.